All right, hope everyone's having a nice weekend. It's Koosh with our weekly market update. It is Sunday, and I'm going to do a few things today. I'm going to do Bitcoin. I'm going to do ETH, which I don't typically do in the general update. I do a lot more in subs. I'm going to do the dollar. I'm going to do the NASDAQ, and then I'm going to do gold, and I'm going to do yields. And that should round out the agenda for today, folks. We're in it. You're in it right now. And just a reminder, I'm not a financial advisor. Most of you know that. If you're new to me, I am just here to give you my convictions, my thoughts. As always, I could be wrong. Everything I talk about could go up, could go down, they could go sideways. And I'm just here giving you my read on the markets. And my read right now is we're in the midst of one of the largest rallies in front of us, the early stages that we've seen up to this point since I've been doing these videos back in this region. This is Bitcoin weekly chart. This is when I started doing these videos on YouTube. And up to this point, we've essentially been in the largest reaccumulation structure Bitcoin has seen. Really since its inception, in my opinion. When you look at how long this reaccumulation has lasted from February 2021, and then we could really call the check back here in early April, potentially, the check back to this reaccumulation. And I believe the bottom's in, as I've said in previous videos. I don't believe this gets tested. My belief is when a spring is loaded, okay, when a spring is loaded, and that's all reaccumulation is, right? From a physics standpoint, Hooke's law, an elastic object, when force is exerted on it in one direction, equal to or greater force is then that energy is then released in the opposite direction. Okay. And if it's truly an energy release, you don't expect to see sputters back to the source of that energy release, right? Think about that like a spring. If it's really loaded, you shouldn't get back to the origin of where that energy is released. And so I think 70, whatever it was, 74 is as much as you're going to get. And from here, I think we have at least two fairly large impulses left. This one, I think, gets us to 180 to 200K. And I've been asked, why do I think that, and why not 140? It's because of this. This is why. This is underestimated by the market. The energy in such a massive reaccumulation event to be released, I think you can't underestimate. This is the most bullish technical setup in finance as well. If we look at some of the pair charts, which I do in the members and subs videos, denominate this in anything you want. SPX, you can do this yourself. Type it into TradingView. BTC divided by, where you've got the equation. SPX divided by Nikkei divided by NDQ divided by anything you want up to this point. And that's telling a story in and of itself, and that's not a story that exactly is hidden or concealed. And the expression in USD terms isn't hidden or concealed either. So yeah, we'll see what the next couple weeks bring, but for now, I'm looking for continuation. ETH, I think the bottom's in on ETH as well. And what the ETH chart does a really good job of describing is, in essence, what we just went through the last few weeks being very similar to the COVID crash in terms of the effect on risk assets, on many risk assets. And so my belief here is if we're looking at Ethereum, this is a weekly chart. These structures are very similar, and as they should be. Reaccumulation structures to varying degrees are similar in terms of how they unfold, in terms of what section of the reaccumulation, what phase you are, A, B, C, D, E. And if we look back let's just study the 2017 blow off top right? Which you kind of had this little head and shoulders. You had a buying climax, you had an up thrust, you had kind of this testing move, head and shoulders, whatever you want to call it. You had this failure, and you had a measured move down into the selling climax, had this automatic reaction, and then COVID was a test. Okay, basically the test of this massive, reaccumulation. And after that test, you then came out, last point of support, sign of strength, expansion. Okay, this expansion moved into a buying climax. Okay, then you had an up thrust in phase B. This is distribution. You had a test to the last point of supply, LPSY. For anyone not familiar with the things I'm talking about, you can pull up Wyckoff, distribution, redistributions, and you'll see some of the things I'm referring to. I'm not going through that today. Same type of concept here, right? You had this head and shoulders, head and shoulders. These are very common type patterns in what you'd see in a redistribution, okay? Failure, selling climax, test, LPS, automatic reaction, and then all the way back into a test. This essentially was a COVID style drop. And so where does this occur? In the context of time, late in the reaccumulation. Where did this occur in the context of time? Late. These tend to be, for lack of a better term, I mean, this technically is in a spring because you had lows swept before it, you had a selling climax before it, but in essence, that's what this acts as, is a spring, in my opinion, in terms of catapulting price and starting the expansive trend, okay? Much like we saw here. Man, there's a lot of drawings on this chart. Let me get rid of it. So basically, the illustration, the chart here is telling me that my belief here is that we're at the early stages of ETH's massive move, and I'm targeting 13,712 on ETH. NASDAQ, this is one of my favorite charts. I was presenting this for the last month and a half, just saying that, look, I don't believe bear markets start when everybody is expecting them. This is NASDAQ. This is fear and greed at the bottom. Bear markets start, complacency breeds the start of new trends, not obviousness. What do I mean by that? I mean, let's look at the example of what I mean. October 2018, the first trend change illustrated here on my weekly chart in the NASDAQ. Fear, greed levels here. Complacency, right? Complacency shoulder, whatever you want to call it, bear flag. And the market wasn't fearful. That was the first trend change. You had a rejection of the 30-week. And you had initial support in the cloud, then it fell out of the cloud. But then the market, this was just an intermediary trend change in the context of a bull market. But notice fear wasn't rampant in the market, okay? All right, let's get rid of that. Where was the next big trend change? When did that occur? Actually, let's not fast forward to that one. Let's go to our next very fearful event, and that was COVID here, okay? Fear was fairly high, higher than it had been for the last 10 years in the market. We popped out of the bottom of the Ichimoku cloud and then reclaimed it, and then V recovery to the tune of 83% rally. Okay, reclaimed the 30-week. How many weeks after it was lost? 1, 2, 3, 4, 5, 6. 6 weeks after it was lost, it was reclaimed, and then the market went on to make new all-time highs. The last real, I don't want to call it bear market. It was technically a bear market, but it was a bull market correction, technically, in my book, in terms of the secular bull market that started in 2008, 2009. That was born in no one knowing what the heck or caring about anything. See that fear and greed? See this down here? Not scared, barely scared, neutral. So a B wave was born in this cloud, rejected under the 30-week. Okay, we had a change in character in the market, and then we had a break in the structure of the market, and then it took what? That break in structure, May 2022, it took a year to get back to that same level. That's that's a trend change. That's a heck of a trend change. And it took a while for the market to recover. But again, this was born when the market was not scared or nervous. That's why they call these things complacency, or I went over this in the members video earlier today, head and shoulders, whatever you want to call it, right? There's a shoulder. These are shoulders or B waves or complacency because people aren't expecting them because they aren't scared. The opposite of what I'm going to share with you happened and transpired in the last month. There was no complacency. There was outright panic, expressed itself in markets, expressed itself as I showed you in ETH and risk assets and ARK, things that went down 30, 40, 50%. That was the major correction we just went through. That was it. That was it, in my opinion. Fact, that's my opinion. The next two major fear levels here. So August and April of last year resulted in V-shaped recoveries, 20%, 27%. And now let's fast forward to where we are today. Okay. I continued to say that, look, and by the way, let me zoom out on this chart. Look at fear levels. They were never as low as they were the week of Monday, April 7th, not even COVID. That's pretty incredible. According to this metric, that indicator, the fear and greed indicator on TradingView. All right. So, do I think that a complacency right shoulder is developed when maximum fear occurs in the market? No, I don't. I don't think that. I think maximum fear occurs, for those of you that have been following me for a while know I combine Elliott wave, Wyckoff, trend analysis. And an Elliott wave, at the bottom of either a 2 or a 4, you see maximum fear. In a B wave, okay, so B wave with what this is the start of something new, bear market, you're assuming that this is a B wave rally. The bottom here of what's the start of B wave is not going to breed maximum fear. In my opinion, that is not a characteristic. It's not what we're going to see in market participants. But I can continue to say the only place anyone has any kind of case for trend change is if this is the kind of price action that develops that we, try to make a move out of the cloud here, bump up against a 30-week, and then reject. And then since we have a change in character, we would then have a break in structure, okay? I would then entertain, if that were to happen, which would happen sometime in July or June, something like that. I would then entertain to say, all right, maybe this is something that's going to last a bit longer and could take us 6 months to a year to get back to these levels. But we aren't there. And I'm certainly not making that that isn't a base case when fear is at what was at an all-time high. The base case is this is a V-shaped recovery. That's the base case. And so far, it's holding true. We close the week above the cloud. Doesn't mean that we can't get a consolidation week in the cloud. But what I'm looking for in the next 2 weeks is a break above this 30-week. And I think we get it within the next 2 weeks of May. So I'm looking for a close above 20,623 within 2 weeks, first 2 weeks of May. And that confirms the V-shaped recovery thesis, and then we're in all-time highs, in a matter of months, in my opinion. All right, that's NASDAQ. The dollar continues to do what we've been tracking since our latest claim of an upthrust back in January this year. Might be some consolidations along the way, but folks, this is a complex redistribution, is what I've been claiming this has been. And what have we seen since this upthrust? My claim here, this upthrust after distribution, boom, straight down. Doesn't mean we can't get some consolidation under this level here, because this is a major floor. Doesn't mean we can't get some, I'm sure shorts stop losses are in this region. So the market's going to, inflict pain, and probably wouldn't surprise me to take some of those stop losses before coming down for another leg. But make no mistake, markdown is next, in my opinion. And the markdown phase coming out of a complex redistribution is where Bitcoin and risk assets are going to perform, historically have performed the best. And so I continue to say, for a variety of different reasons, the greatest from a price appreciation and timing standpoint, the amount of time it's going to take, gains are in front of us in the market. Gold, I'm on board with a little top here. This has, this has met the requirements for a mini blow off top. That does not mean I think gold is starting a bear market. No, my claim here on gold is 20-30% drop into the end of the year, and then that the macro move to gold I see going to 8,000, 9,000 within the next 3, 4, 5 years, something to that effect, maybe less, maybe more. The secular trend here is just too powerful. If we look at the monthly, we pull a monthly channel up on gold, this is just too powerful. Too powerful. So that's my view on gold. Yields, again, doing what we've been forecasting them to do. I was calling for a major drop coming out of this failed breakout. We got it. And then I said, snap back for a right shoulder. Okay. Head, right shoulder, snap back for a right shoulder. We got it. But what do we get this week? And for those of you that subscribe and are members to my additional content, how much attention I pay to this 30-week moving average, and we got a failure below it. This is B wave written all over it. That's what a B wave looks like, where you get this snapback, B, and I expect C is next, which means that the biggest drop in rates is in front of us, regardless of what the Fed does. I don't care. Fed doesn't matter. I don't even know when the next meeting is. Okay, couldn't tell you. I'm sure it's sometime in May, but what I'm getting at is this chart tells me what's going on with yields, and in my opinion, we're setting up for year end 3.4, 3.3, 3.2, fast and furious to the downside. Folks, that's it. I hope you enjoyed the video. Take care. Have a great rest of your weekend, and we look forward to a pretty solid few weeks coming up here. Take care.